Bitcoin fell through the mid-70,000s over the weekend, then snapped back towards $79,000 within about 48 hours. That move was not random. It was a stress test for how crypto trades when the dollar jolts higher and leverage gets forced out fast. By the end, you will know what actually drove the drop, why the rebound happened anyway, and 3 concrete signals you can track this week to see if the shakeout is done. Here is the clean timeline. Late last week, markets digested new political pressure around the Federal Reserve. President Donald Trump nominated Kevin Warsh to be the next Fed chair. The headline landed into a market already sensitive to rates and dollar strength, and it hit right before the weekend liquidity thin-out. Risk faded, the dollar firmed, and crypto did what it often does in that exact setup. It deleveraged. You can literally see the thin liquidity fingerprint. CME Bitcoin futures closed Friday around the mid-84,000s and reopened Sunday in the high 70,000s, leaving a large weekend gap. That is the kind of gap you get when spot trades all weekend, futures do not, and price moves on a smaller pool of liquidity. Then the second shoe dropped. As price slid, liquidation engines kicked in. Reuters reported roughly $2.56 billion of Bitcoin-linked liquidations over recent days, using CoinGlass data. That is forced selling, not a thoughtful macro reallocation. When that flow hits, it can overshoot support levels because it is mechanical. Now the real question is why the rebound showed up so quickly. And here is the mechanism in plain English. Bitcoin did not decide to be strong. The selling pressure simply ran into a new buyer, and the dollar impulse cooled a bit. The market went from panic selling to bargain hunting the moment the forced liquidation slowed. Let's translate that into market language because the structure matters. In market terms, this was a dollar and rates shock that hit a leverage-heavy asset into a weekend liquidity vacuum, then bounced when deleveraging cleared. In plain English, it was a crowded trade getting pushed down a staircase, then popping back when the stampede ended. Hold that thought, because I want an anchor example you can keep in your head the whole video. Meet Alex. Alex is not a Bitcoin maximalist. Alex is a macro trader using leverage because the carry looks attractive when volatility is quiet. Alex holds Bitcoin exposure through perps and through a spot ETF because it is fast and liquid. Alex is fine when price drifts. Alex is not fine when the dollar rips and liquidity disappears. Block 1 is the spark. Why does a Fed chair nomination matter for Bitcoin at all? Not because one person changes Bitcoin's code, because markets trade the expected path of interest rates and the credibility of the central bank. If traders think the next chair could lean more hawkish, the path of rates can reprice. A hawkish reprice usually supports the dollar, and a stronger dollar is often a headwind for duration-like risk assets, including growth stocks and crypto. Here is the key detail. The market did not need certainty. It only needed enough uncertainty to widen the range of outcomes. When uncertainty rises, the first thing that gets punished is leverage. So, what did the tape look like? Bitcoin dropped under $75,000 at the lows in some reports, then recovered towards $78,000 to $79,000 as the dollar eased. That is not a subtle move. It is the kind of move that flips risk managers from monitor to cut exposure now. Now check the ETF layer because that is where the new market plumbing shows up. When you see sharp spot ETF outflows, you are watching real cash leave a wrapper that a lot of discretionary investors use. When you see inflows, you are watching the opposite. BlackRock's iShares Bitcoin Trust reported a large asset base and a meaningful one-day NAV drop around this window, which lines up with the sell-off. This matters for Alex. If Alex holds some exposure through an ETF, outflows can mean the marginal buyer is stepping back. If Alex holds leverage through perps, forced liquidations can mean Alex is selling at the worst possible moment. Same direction, different pipes. Here is the part most people miss. When spot falls fast, the derivatives market can amplify it. You get margin calls, you get liquidations, you get options dealers hedging. That hedging can add more selling pressure. And because this happened into a weekend, the feedback loop is faster. So the first big mechanism chain is simple. Step 1. A policy credibility headline raises rate uncertainty. Step 2. The dollar firms, risk appetite softens. Step 3. Bitcoin sells into thin liquidity. Step 4. liquidations force extra selling. Step 5, once liquidations slow, price can rebound violently. Plain English translation. The price did not fall because everyone suddenly hated Bitcoin. It fell because too many people were positioned the same way, and the exit got narrow. Now we have to answer the why it matters question, because the point is not Bitcoin drama. The point is what this tells you about the broader risk environment. When Bitcoin can gap down like this on a macro headline, it is telling you that the market is still running hot with leverage. And when the rebound is that quick, it is telling you there is still demand under the surface. For Alex, the consequence changes already. Before the weekend, Alex's risk model probably assumed normal liquidity and modest intraday swings. After the weekend, Alex has to assume liquidity can vanish and correlations can jump. That means Alex either reduces leverage or pays more for protection. Either way, the cost of holding risk goes up. We are going to keep revisiting Alex because the next block is where the real what breaks first pressure point lives. Now, zoom out to the part that actually matters. Bitcoin is not just a coin. In this market cycle, it is also a leverage barometer. When it dumps fast, it is often telling you leverage is high and exits are crowded. When it rebounds fast, it is often telling you there is still real bid under the surface. Both can be true at once. So, let's talk about what really drove the drop, beyond the headline. The core driver was positioning plus liquidity. That is the whole story. A policy headline can be the match, but the gasoline is leverage. Here is the second mechanism chain, and this one is microstructure. Step 1, price slips and implied volatility jumps. Step 2, perps funding can flip, spreads widen, and margin requirements bite. Step 3, liquidation thresholds get hit and forced selling triggers more selling. Step 4, the options market starts to matter more because dealer hedging increases sensitivity around key strikes. Step 5, once that forced flow is done, the remaining market is mostly voluntary, so price can stabilize and rebound. Plain English translation. The crash is not always a narrative. Sometimes it is a cascade of rules. Now, a common misread I keep seeing is this. If Bitcoin fell, it means everyone is risk-off. That sounds clean. It is also wrong. A liquidation cascade can happen even while long-term holders are not doing anything. Forced sellers are not the whole market. They are just the loudest for a short window. So, how do we tell the difference between a real regime change and a leverage flush? You watch the pipes, not the opinions. Let's bring Alex back. Alex got hit because Alex used leverage into a weekend. If Alex got liquidated, Alex becomes a seller regardless of beliefs. That is why the sell-off felt panicky. It was mechanical. Now, what about the rebound? The rebound usually needs 3 things. 1, the forced selling slows. 2, someone is willing to buy the dip, usually spot buyers. 3, the macro impulse stops getting worse, even if it is not good. In this case, you had at least 2 of those 3. The liquidation pressure eased and buyers stepped in. And the macro impulse, meaning the dollar and rate expectations, did not keep accelerating in the same direction. Here's a useful mental model. When Bitcoin falls on a macro shock, you can think of it as a 2-part move. The first leg is repricing, the second leg is positioning. The first leg is a rational revaluation of risk. The second leg is a forced cleanout of leverage. The second leg is the one that overshoots. That distinction matters for what comes next. If it was mostly a positioning flush, you can get a V-shaped bounce and then a grind. If it was a true macro repricing, the bounce fails and the trend continues down. So, the rest of this video is about those decision points. Now, we get to the what breaks first pressure point. The first thing that breaks is not Bitcoin. The first thing that breaks is the cost of holding leverage exposure. In crypto terms, that shows up in funding rates, basis, and liquidation prints. In traditional terms, it shows up in the dollar, real yields, and broader financial conditions. So here are the 3 signals to watch this week. Only 3, concrete and trackable. Signal 1 is the dollar, where to look. The DXY and major pairs like USD and USDJPY. What direction matters? If the dollar keeps climbing, it tightens the screws on global risk assets. Typical lag, crypto often reacts quickly, sometimes same day, especially when liquidity is thin. Signal 2 is rates. Where to look? The US 10-year yield and the front-end expectations, like Fed funds, futures pricing. What direction matters? If yields push higher and expectations shift toward higher for longer, the rebound in Bitcoin becomes harder to sustain. Typical lag. You can see stress in crypto within hours, but the real follow-through usually shows up over 24 to 72 hours. Signal 3 is crypto leverage. Where to look? Perp funding rates, open interest, and liquidation dashboards, plus spot Bitcoin ETF flow headlines. What direction matters? If funding stays elevated on the rebound and open interest rebuilds fast, it sets up another flush. If funding normalizes and open interest cools, the move is healthier. Typical lag. Funding can change intraday. ETF flows tend to show up daily. Liquidations spike when price crosses key levels. Now stakes, because viewers care about what changes in their world. Over the next 24 to 72 hours, the risk is a gap fill fight. If price rallies back toward the prior futures close, the market will test whether that zone is real resistance or just a scar. If the market stalls there and leverage rebuilds, another sharp downdraft is possible. If the market reclaims that zone with calm funding, it is a sign the flush did its job. Over the next 2 to 6 weeks, the story becomes macro again. If policy credibility questions keep building, or the dollar keeps trending higher, Bitcoin will trade more like a high beta risk asset. If macro stabilizes, crypto can detach and focus on its own demand drivers, like spot accumulation and ETF flows. And if this persists, meaning repeated liquidation weekends and repeated sharp gaps, you get a structural change. Liquidity providers widen spreads, implied volatility stays higher, and the market becomes more fragile. That raises the cost of being Alex. So, what does Alex do next in our scenario? Alex either stops using leverage into weekends, or Alex buys protection, or Alex reduces position size. That sounds boring. It is also how markets change. A lot of big moves are just risk models rewriting their assumptions. Now let's make it real. Imagine you are running a business that accepts Bitcoin payments, or you are an importer with some crypto exposure as a hedge, or you are just a household watching a volatile asset. The difference between a normal market and a fragile market is not the price level. It is whether the market can absorb shocks without forced selling. Plain English translation. The risk is not Bitcoin down. The risk is forced selling is back. Next, I want to walk through the cleanest on-screen receipts you can use to make this story undeniable, and how to narrate them without hype. Here are the receipts that make this story concrete, and not vibes. Receipt moment 1 is the futures gap. On screen, show the CME Bitcoin futures Friday close, then the Sunday reopen. If you show that gap alongside the weekend spot, move, you are showing the viewer the liquidity reality. Futures pause, spot keeps trading. When the market moves hard in that window, it can look like a sudden collapse, even when it is just the difference between two trading schedules. Receipt moment 2 is the liquidation print. Put the liquidation number on screen and say it slowly. Reuters cited roughly $256 billion of Bitcoin-linked liquidations in recent days based on CoinGlass data. That number is your proof that this was not only discretionary selling, that is forced flow. That is margin systems doing exactly what they are designed to do. Then add one more primary style receipt, so you are not relying on one narrative. Pull up the official Fed Chair nomination release. It is a direct, dated statement from the White House. It is not an opinion piece. It anchors the what change part of the timeline. Now the key is how you explain these receipts without turning it into a crypto soap opera. You say this: the policy headline raised the rate uncertainty. That tends to support the dollar. Bitcoin is sensitive to dollar upswings, especially when leverage is high. Then the weekend liquidity window magnified the move. Then liquidations forced extra selling. And the rebound happened when that forced selling slowed and dip buyers stepped in. That is the mechanism. 3 steps, clean. No mysticism. Now here is the second common misread, and this one is everywhere. If Bitcoin bounced, it means the danger is over. That is also wrong. A rebound can simply mean the forced selling ended. It does not automatically mean conditions improved. The market can bounce and still be fragile. So how do you test if this bounce is real or just a dead cat snapback? You test the 3 signals and you do it in order. First, the dollar. If DXY continues to trend higher, it is a headwind for risk. If the dollar stalls or softens, Bitcoin can breathe. You do not need perfection. You need the pressure to stop increasing. Second, rates. Watch the 10-year yield and the front-end pricing. If yields push higher and the market reprices higher for longer, you often see the next wave of stress show up quickly in high beta assets. If yields calm down, you can get a more stable crypto tape. Third, leverage. This is the big one for whether Alex gets hurt again. Watch perp funding and open interest. If funding spikes positive and open interest rebuilds fast, you are recreating the same conditions that caused the flush. If funding normalizes and open interest cools while price holds, that is healthier. Pair that with spot ETF flow headlines, because those flows tell you whether the wrapper buyer is stepping in or stepping out. Now, revisit Alex one last time, because it ties the whole story together. Alex's original bet was simple. Vol is low, liquidity is deep, leverage is cheap. The weekend proved at least two of those assumptions can break fast. Alex's next decision will show up in the market data. If Alex and traders like Alex come back immediately and rebuild leverage, you will see it in open interest and funding. If Alex backs off, you will see the opposite. That is why these signals are not crypto nerd indicators. They are the market's heartbeat. Now, put the stakes ladder into one clean paragraph. In the next 24 to 72 hours, the market is basically asking one question. Can Bitcoin reclaim prior resistance levels without rebuilding fragile leverage? If it fails and leverage is already high again, a second flush is possible. In the next 2 to 6 weeks, the question shifts to policy credibility and macro conditions. If the dollar stays strong and yields stay elevated, Bitcoin can keep trading like a high beta risk asset. If macro stabilizes, the market can focus more on spot demand and flow. And if this persists, repeated weekend gaps and repeated liquidation cascades change behavior. Liquidity providers widen spreads, volatility stays up, and the market becomes easier to knock over. That is the real risk. So here is the recap in plain English. Bitcoin's weekend drop was a leverage flush into thin liquidity, triggered by a macro credibility headline that supported the dollar. The rebound does not automatically mean safety. It means the forced selling probably eased. The next move depends on whether macro pressure keeps rising and whether leverage rebuilds too fast. And to keep this practical, the three signals again. Signal 1, the dollar. DXY and major pairs. If it keeps climbing, pressure rises. Same-day effects are common. Signal 2, rates. The 10-year and front-end pricing. Higher yields make the rebound harder. The lag is often 24 to 72 hours. Signal 3, leverage. Funding, open interest, liquidations, and spot Bitcoin ETF flow headlines. If leverage rebuilds fast, fragility returns. If it normalizes, the market can stabilize. That's the risk, and that's the recap. If you want the clean signal check, look at those three markers this week. I'll see you in the next one.